Thanks for tuning into Talking Point. I'm your host, Neeraj Shah. We are going to debate about a particular point with our guest in the first segment today, and that is around the stretched valuations in select pockets. Let me give you a glimpse of why I'm saying this, and then I'll welcome in our guest, Andrew Holland, on the show today. Look at this. So I'm comparing, let's say, HAL with Dassault Aviation. Revenues for HAL, $3.5 billion odd, Dassault slightly more, PAT almost similar, but the economic value of a HAL at $41 billion versus Dassault at about $6.5 billion. Do you see the difference in the valuation, or how well are some of the Indian stocks valued, or are they stretched maybe? Mazagon. Well, this is a note that I borrowed from Omkara Capital. Huntington Ingalls, it's a US-based company. The EV is nearly equal to Mazagon's EV of about $12 billion. But the point being, if you look at the other aspects, revenue is less than 10% of Mazagon Dock versus Huntington Ingalls, which means Mazagon's revenue is 10% versus this company, while they have the same EV. Yesterday, a note from Kotak Securities laid out this very interesting thing about BHEL. By the way, the stock is up today. Rajat Bose has said the stock could go all the way to 350. But the market cap, according to Kotak, of BHEL implies that the company needs to execute 25 gigawatts of annual thermal ordering for perpetuity. That's the point. And then you look at the market cap to sales numbers of so many of these stocks. BDL, market cap to sales ratio 26 times, ITI 22 times, SJVN 21 times, Cochin Shipyard 19 times, Hindustan Copper 18 times, FAT 13 times. These stocks are expensive. They're not restricted only to defense. It's across a lot of PSUs, maybe in select cases, private companies as well. And to our guest, Andrew Holland, as I welcome in on the show today, that is my first question. Andrew, thanks, of course, for firstly accepting our request to talk to us today. And good morning to you. But I'd like to start off with this question, Andrew, that one can never call the top, but should one legitimately question the kind of valuations at which some of these PSUs, defense, non-defense, etc., are trading at?
Yeah, good morning, Neeraj, and thank you for the opportunity. It's a great question. And, there's two ways to think about it. I mean, the easy way is to say, yes, valuations are stretched, and that's going to be a problem. And I think for some of the companies that will be the case. But, your comparisons with some of the overseas companies is interesting. I'm going to take it slightly differently in a few minutes as well. But here's what I think is that, the growth potential in India is so huge in these sectors, in terms of the expenditure, which will continue for many, many years. And, obviously, the growth potential for some of these listed companies overseas is probably less, that in terms of the potential going forward. So I think you've got to look, and there's an interesting study we did many, many years back, where you looked at kind of Nestlé's valuations, as a whole of the European Union, the UK kind of rose in terms of consumer spending. It was always on 40, 50 times throughout that period. And this is the growth of India now. So I suspect you're going to have high valuations, that some will get stretched, as you rightly point out. But the different angle is here, I just take it slightly differently, is, Hyundai's IPO is coming out. Now, I've seen some of the valuations they're talking about. That's, a large percentage of Hyundai Motors' Korean market cap, because the potential is there, for these companies, given India's kind of growth rates going forward. And obviously, the fact that, these economies themselves are kind of, saturated, and there's not really that much growth for them. So I think you have to kind of look at it from a growth PE in terms of India's valuations. But I agree that some of the companies, and I would say this probably more so in the industrial side, where I look at the L&Ts and the BHLs of this world in terms of the order flow, because that's the move of the share price. Execution is a completely different thing. And as we've seen in the past, execution is always disappointed to some extent. So if you think order flows are coming in, these share prices will remain high.
Okay. Andrew, but the question is, if you had these stocks in your portfolio, your purchase price doesn't matter, whether you're sitting on 30% gains or 100% gains, you're effectively using this amount as your capital. Would you take some chips off the table within this bucket, be it defense, be it fertilizers, be it some of these capital good executors like BHEL?
Yeah, it depends what the opportunity cost of keeping in them compared to other opportunities. So I could see that there'd be other opportunities in different segments of the market, which I would want to kind of play in on a kind of a longer term theme. So yes, if it's hit my target prices, then I'd be looking at saying, okay, I may incrementally going to get another, let's say 50% over the next 1 year or so, or is it going to be lower than that? And if I had another opportunity, let's just say in one of the sectors I like is beverages. If I feel that beverages is going to give me a better return, then I'd obviously switch some of my some of that money into this sector.
Got it. Andrew, what will make you, so what within this very stretched set of names, where is it that you are comfortable? I heard you say that one, it is an opportunity cost that you would look at, and two, in select cases, maybe growth makes up for it. Where is it that you believe that these egregious valuations are justified, and why so?
No, I'm not saying that the
no,
valuations
if they are,
are justified.
sorry, I'm asking you.
Yeah. I think for there's three things I know. There's three sectors I can hand on heart say I know there's going to be significant investment over the next 3 to 5 years: defense, renewable energy, and railways. That's going to be the focus of the government. So you're going to see more and more order flows in these sectors, which drive share prices. I'm not saying the valuations are correct, because execution will still be the key. But in this kind of market where you're looking at the growth sectors, then these companies will see turnover, if you look 3 years out, will be significantly higher than you're seeing today. So the PE you're looking at today will be completely different than it will be in 3 years' time. And that's how you got to fast forward, not look at the PE today, say, what's that PE in 3 to 5 years' time? And does it justify it? So if you say your PE is 60, 70, but in 3 to 4 years' time, it's nearer to 20, if you still got a valuation which is reasonable.
Got it. Andrew, just a word. The bull will argue that there is order visibility. The book to bill looks very, very strong. And there is a bit of a ring fencing of domestic defense, in that the orders are going to them. They are not necessarily going to export oriented firms. And if anything, some of these companies will be able to export in times to come. Can one make a legit case, therefore, for some of these defense names in particular, shipbuilding or defense names, to trade at this 60, 70 PE multiple?
To my mind, that's an argument which I wouldn't be kind of so excited about. I mean, I can see the electronic manufacturing, for example, Niraj, but shipbuilding is slightly different. There's huge competition elsewhere in the world, so I'm not sure that the export kind of thing plays to my mind. Again, it's a very simple. If you expect orders to come in, most of these stocks the per share price will move on order intakes, and that's it. So if you think the order intake's slowing, for the next, say, 6 months or 9 months, then maybe these shares will at best tread water, if not go down, because there's no new excitement to come in. The problem for the defense sector is very lumpy in the orders, and you don't know when they're going to come, because obviously because of the nature of the orders given by the government. So in terms of they're more sensitive. So you could be looking at some big orders coming, but you just miss out by the fact that you've taken some profits off the table. But I'm not big on this export thing for these sectors. I'm big on the fact that if you expect order inflows to come, which we do, then share prices will react to that.
Got it. Okay. One final question on this piece, Andrew, and then we move on to other pockets as well today, because I want to understand from you what is your positioning on the market. But one final question on this. A lot of other PSUs have benefited, wherein the sectors have seen a change which they didn't before. Railway wagon manufacturers, for example. I mean, when capital put in money into Titagarh wagons or Titagarh rail systems at 500, people raise their eyebrows. The stock is at 1800 now. Jupiter Wagons QIP seems to have been latched up very, very strongly as well. What's happening with these names? We know there's a policy out there. People are penciling in targets till 2042. I saw an HSBC note to that effect. What do you do with some of these names?
Again, it goes back to your views on two things. One, will the government increase spending on railways over the next, say, 2 to 3 years, and by what amount you think that will be? When will that order inflow starts to happen, and how quickly will it then translate from expenditure on railways to wagons? So if you expect all of those to kind of converge very quickly, then obviously, again, I'm going back to order flows will move the share price. If you look at the last cycle, 2002 to 2008, you look at some of those old kind of infrastructure stocks and railway stocks, it was exactly the same, Niraj. So until something happens which changes this scenario in terms of the markets globally, then this is what we're going to continue to see in terms of share price movement. So I'm trying to say here, in fighting the trend, fundamentally you can sit there and say, I don't want to buy anything on 60, 70 times. It'll take 3 years to kind of see that through to earnings, but order flows will continue to happen. So each time an analyst will say, okay, we've got more orders, I'm increasing my forecast by this. And that's the worry, is that you're looking at today and you're not saying that order inflows could have any more impact on your earnings potential going forward.
Given a choice right now, would you be having a significant short position or not quite on the market-wide?
No, wouldn't be doing that, Niraj. It's too fraught with danger. I think over the last 6 months, we've talked about many different things globally which could hurt the markets. The markets just shrugged them off. I mean, again, you talked about valuations here. What about valuations in the US? Given that interest rates have risen so much there, it's as though nothing ever happened with interest rates. I mean, did it really matter? And the data is just all over the place. I mean, you saw obviously the jobs data last week where they revised the previous months by a very significant amount. So I don't think the data is telling me anything. I think we'll just have to wait for the economy to slow enough for them to bring interest rates. But I think the narrative is changing again back towards September. So that's the good news. And of course, we've got our budget coming up. And I suspect that the play will be, consumer stocks, and I know you want to talk about that, which will kind of lend an extra leg maybe to the market ahead of the budget, and keep us where we are till the budget is over. If there's any risks, with capital gains tax, being played out or not, and I think that's where the market is. I think thereafter, Niraj, I don't see that there's any real reason for markets to continue to move higher if the result season itself is not as compelling in terms of the growth that we've all been expecting.
Okay, so don't necessarily wait for the economy to slow, show it in the numbers, and then do, because this market has a habit of shrugging off any kind of worries that come in. Could it the same be true for banking, Andrew? That's a key question, because a lot of hope piled up. There's a bit of a rally from the recent lows, but the numbers that have come out thus far as Q1 updates haven't quite looked very impressive. Granted, it's a seasonally weak, sluggish quarter, but even then, they've looked slightly wobbly.
Yeah, no, I agree. It's not again, it's been like, I suppose, as we've been discussing the IT sector over the past few quarters or more, is when are you going to reach the bottom? I think we're there or thereabouts. I mean, maybe these results will be a little bit more disappointing. But with bond yields falling, with the inclusion in the JP Morgan index, I do think that bond yields in India will start to head lower. And it's something we talked about before. And I think that gives you, that opportunity for the banks to get those, obviously there's mark-to-market gains on their books. And that could be, the catalyst which will help, if I'm not saying push the share prices up, but at least stabilize them. And then as the recovery comes through, as interest rates get lowered, this will be the next kind of big move for the banking sector. So I really do like the banking sector. Private banks is where I'd be. And again, just thinking ahead to the budget, if there is spending on the rural economy, I think affordable housing is going to be one of them. So I would look at those financiers, again, who are more towards kind of financing affordable homes.
Okay. Andrew, the other one that is a bit confusing currently is, actually before that, just one quick word. Andrew, you've been, if I'm not wrong, constructive on this capital marketplace with reason in the past. Post this whole set of rules and regulations that are coming in, especially on brokers, etc., does it narrow down the attractiveness of the available pockets within the capital market landscape?
No, I think unless you think there's going to be a big shift, then I think asset management companies will continue to do well going forward. So, that's the pocket I like for the longer term, because, more and more people will put their money towards equities markets as we go forward. And as the economy continues to grow. So, simple thinking here, Niraj, is that if you expect the the economy to be a $10 trillion economy, the market cap of India should be around the same at some point. So I would say that asset management companies should be a good long-term bet in that respect.
So as AMCs are okay, what about brokerage stocks?
Yeah, I'm not. I'm more thinking on the asset management companies rather than brokerage. Yeah.
Got it. Okay, fair call. Now, Andrew, the other aspect is consumption, right? FMCG stocks have suddenly risen from the ashes post the quarterly updates as well. Just trying to think within staples or premium consumptions or other forms of consumptions, QSRs, etc. Where is it that you're most constructive on, if at all?
Listen, I think the call ahead of the budget, as I said, is more of a. I think it's more of a trading call for the FMCGs, the big heavyweight FMCGs, that is. Partly because, even if the rural economy is given some funds, it will take time to filter through, Niraj. So it's not as though FMCG companies are going to see growth of 20 to 30% on the top line. It's just not going to happen. So yes, a good play ahead of the budget. But if consumption is going to come through, then I mentioned about affordable housing. So then I think about affordable housing. I think about paint. I think about steel. I think about cement. But really, the play for me within the consumption sector is the beverages and this premiumization, which we talked about before, because it's not going to go away. If anything, it's going to accelerate if the rural economy picks up as well. So I would very clearly stick to those companies in the beverage industries, both alcohol and non-alcoholic, because I think those are going to be the runways. We're just hitting the runway, so I think there's a long way to go, and it could be accelerated if there is a push towards reviving the rural economy in terms of consumption.
So you don't mind buying the the staples at these valuations, Andrew? I mean, this you're comfortable with that? Just reiterating.
So in terms of like what I would clearly say the FMCG companies, I think it's a trade ahead of the budget.
So, okay, look at it that way, viewers. Andrew Holland is saying it's a trade ahead of the budget. My final question, Andrew, again on consumption. The last 3 years, premiumization, premium consumption, tourism, liquor stocks, watch stocks, etc., all of them have been in focus. Do people get out of those to pile into this form of consumption for the trade, or that continues, but other sectors will lose out and maybe a trade into staples might happen?
So I think the short-term trade is staples. I think the better trade is in terms of the more kind of short to medium term is your premiumization stocks, because I think the runway there is a lot longer and a lot more in terms of growth than you're going to see from a pure FMCG company. Let's just take ITC, not to talk as a stock as a buy, sell, or a hold, but it's got one revenue base, right? Now, yes, it's the emerging hotels and so forth, but that's where you want to be. You want to be in the sectors where you're going to see huge growth, and leisure, premiumization in terms of beverages is just not going away from us, Niraj, and I think that's where I'd want to play the consumption story.
Okay, so Andrew, just rechecking that the staples trade will not happen at the expense of the premiumization trade. If it has to happen, money may come in from other sectors, but not necessarily from the other end of consumption.
Yeah,
sorry, Andrew, I seem to have lost you. Okay, but I think I got the drift. You're saying that that will not be the impact necessarily. Okay, great. Andrew Holland, thank you so much for taking the time out. We're out of time completely on this leg of Talking Point, but really, really appreciate your time this morning.
My pleasure. Thank you.
Right, just a bit of that audio glitch at the end, but I think we got the gist of what Andrew Holland was trying to say on various sectors, on some of those expensive PSU names as well, and of course market-wide. Not going short as yet because the market has made it a habit of shrugging off all walls of worries, including the worry of valuation. Well, that's all that the time that we have on this edition of Talking Point. Remember, the markets are holding out well, save for IT, which is under a bit of a cloud. Thanks so much for tuning in today.